We will get, yeah, could you? That'd be great. And I'll turn this on. Let's see if I can get the share my screen. And hopefully this will, screen will start sharing. There we go. Okay. So that should be getting brighter behind me there. So last week we did the whole introduction to corporations. I still have the notes here, and I'm keeping these same notes on the same, page, so to speak. I'm just creating a new area for me to give these notes, and this way, when you access them, they're uploaded in last week's Blackboard. They'll be uploaded again this week, but now you'll have extra stuff in there. So last week we were talking about non-corporations versus corporations. I'm just going to scroll down a tad because this is all review. And then we got into closing entries. I mentioned how the first two closing entries are exactly the same in a non-corporation scenario as they are in a corporation, but where things get different is when you get to closing entry 3 and 4. And instead of closing income summary into capital, we are now using retained earnings in place of capital. And we no longer have drawing, we now have dividends to replace it. So I'm going to put that D in dividends in red here, just to remind you of the red accounts. And I'm not sure, I think that's where our focus mainly was last week. And, I think I also did this here. As you can see, we had this one capital account. Remember I said capital used to wear 2 hats, right? It wore the investment hat and it wore the earnings hat. Well, in a corporation setting, we've taken capital and we said, you know what? You're not just wearing one hat, or what you used to do. We're now going to replace your job duties with it's like you being fired and they hire 8 people to do your job. That's kind of like what corporation, the capital accounts in the corporation. So we've got a common stock. We've got a PIK account for common. We've got a preferred stock. It's got a PIK account. We've got retained earnings. And this is just most of them. I'm going to show you a new one tonight. And that'll help us to handle the material that we're going to deal with tonight, which relates to, hey, what happens if you give a stock dividend? So tonight's goal is really just to get into dividends, cash dividends and stock dividends. And if we can get through that tonight, like in an hour or so, we're going to be good. And then next week, we'll clean things up with treasury stock and then just kind of wrap up the whole corporations unit. So I'm going to go to a new sheet, and I'm not going to do the little yellow and green split. We're just in corporations now, no more comparisons. And let's talk about dividends. Can you guys see that okay on the screen from where you're sitting? Okay. So there are 2 types of dividends. There's cash dividends and there's stock dividends. So under cash dividends, there are 3 important dates. Date number 1 is called the date of declaration. Date of declaration. This particular date will require a journal entry on behalf of the company. The second one is called the date of record. And for this one, there is no entry. This is just an FYI. And then the third one is the date of payment. And this requires a journal entry. So date of declaration, date of record, date of payment. The date of declaration journal entry, there are two different versions. Okay? The first version is if the company created a dividends account, okay? And it kind of depends. It's kind of hard to explain here, but let me go back to the closing entries for a moment. Okay? So you see here we have dividends being closed out into retained earnings. Okay? There is a way for corporations to avoid closing entry number 4 completely. Okay? And the way they can eliminate it completely is if they never create a dividends account to begin with. Right? So I just want to just throw that out, and then I'll show you the differences here. Okay? So anyways, so keep in mind that dividends declared, or the dividends accounts, dividend declared, same thing. Okay? Keep in mind that this carries a debit balance. So when you close it, you got to credit it. So it goes up by a debit, it goes down by a credit. Just like drawing. Okay. So when an owner makes a withdrawal, you debit drawing, you credit cash. Well, dividend is just like drawing. So on the date of declaration, the company will debit dividends or dividends declared or dividend declared. And they will credit dividends payable. Now in a counting 1 scenario, the owner makes a withdrawal, they debit drawing, credit cash. But in a corporation setting, the date of declaration is like secret. I think I mentioned something like that last week. You know, if you know that as a stockholder, you're privy to information you're not supposed to know about. Okay, it's insider trading stuff. Okay, so on the date of declaration, the corporation says we are going to give dividends to the stockholders who have the stock as of this date. If we all own that stock, we don't know what that date is. So we may have just bought the stock and got lucky. We may have just sold the stock and got unlucky, or we've held it for years and you know every once in a while we get a dividend check or whatever. But this dividend payable is going to be payable at some future date. Okay, so that is the date of declaration. So I'm going to just put this in yellow and show that in yellow. So I'm now going to put like or another way to do this would be, let's say the company doesn't like to have the 4th closing entry. In a non-corporation setting, we don't have that choice. But in a corporation setting, they might say, you know what, instead of, we know dividends declared ultimately gets closed into retained earnings. Dividends declared sounds like a middleman account. So why put it in dividends if we're just going to close it into retained earnings? Why don't we just do this? So let me just copy this. And instead of debiting dividends declared, some companies will just do that. They will debit retained earnings directly. So if a company does this, I spelled it wrong. If a company debits retained earnings instead of dividends declared, then there is no need for closing entry number 4 because they've already put the dividends in there. So they didn't create it to close it. It's just automatically in retained earnings right out of the chute. So I think our book does the second version. So if you're reading chapter 13 and you get to the dividends, and you're like, hey, where's this one? They may not show this one. They may have taken the shortcut and used retained earnings. So I'm just kind of letting you know that if, depending on what book you're out of, what company you work for, it could be either the first way or the second way. But our book, I think, uses the second way. Okay? So that's the date of declaration. Whatever, board of directors decides to do that. There is no journal entry on the date of record, but when it's time for the date of payment, and I'll put that in blue, I like to use the expression getting rid of the bull, pay a bull. I use it when we get into stock dividends, except we're going to have something called stock dividends distributable. Dividends payable. Whenever you want to get rid of the bull, you got to do the opposite. It's like closing. We're going to debit the bull. So in this case, when it's time to pay it, we're going to debit dividends payable, and we are going to credit cash. So that's the journal entry you would make on the date of payment. So it doesn't matter whether you use this one or the shortcut. The credit in both of those is paid. So when you pay it off, you don't owe them anything. Debit the bull, debit the payable, and credit cash. And there's no journal entry on the date of record. That is like, top secret, the date of record, until the dividends actually come out. Okay, so that's just some notes. All right, now let me give you stuff on stock dividends. And just like in cash dividends, there are 3 important dates. And they're pretty much the same as they were for the cash dividends. I just got to tweak one little piece of language, and that is when I get to number 3, it's not the date of payment because I'm not paying them money. It's the date of distribution, because I'm distributing to them more stock. I'm giving them more stock. So instead of giving them money, it's like what I was talking about last week with a pacifier. You're not giving cash dividend, but I'm going to give you a stock dividend, so stop your whining kind of thing. And who knows, it could, excuse the pun, pay dividends down the road. All right? So when it comes to stock dividends, where it gets different from the cash dividends is that there are 2 types of stock dividends. And it's small versus large. So now I'm going to ask you a favor. I would like you to go digging through your chapter 13 of your textbook, and I want you to tell me the percentage. You may need to use the flashlight on your phone, so we'll look at it in the dark here. But I would like you to look through chapter 13 and see if you can tell me what distinguishes a large stock dividend from a small stock dividend. So I'll shut up for a second and let you kind of dig through it. So it should say something like, there you go. So what is that?
Small stock dividend is 25% or less.
Beautiful. Let me write that down. So small stock dividend is considered small, 25% or less. And what page did you say you found that on? Okay. Oh, okay, hold on. We got two different page numbers. Let's see. Page, what was yours again? 463. Or depending on what book you're in, what's your page number? 552. It's amazing to me. That's like 100 pages difference. It's crazy. It was like that the last time too when I asked for difference in page numbers. Just crazy. So depending on what book you have, obviously you got that. So a small stock dividend is 25% or less. So a large stock dividend obviously would be greater than 25%. Okay. Now, when you do an assignment, when you do a homework question, if I ask you to do something in class here, they're not going to say 25%. They're probably going to say 10% stock dividend, 30% stock. So it's going to be, you won't need to know these percentages. I doubt, who knows, maybe one of the quiz questions on Blackboard, in the blended session might get into this minutia. I don't know. But in terms of calculations, they typically kind of make it obvious. It's a small stock dividend versus a large stock dividend. Okay, so if you have a small stock dividend, there's different rules that apply to both of these. So let's talk small stock dividend. You have to use the market value of the stock. Right? So when we go to do our journal entry, we are going to use market value for the debit to retained earnings. So I'm going to use the shortcut approach like I was talking about before. Remember I said your book likes to use the shortcut. All right? Instead of writing dividends declared with a stock dividend, instead of writing dividends, see, dividends declared is kind of generic. I probably, now that I'm talking about stock dividends, I should probably clarify and say it's really cash dividends declared. And if they were doing a stock dividend, it'd be a stock dividends declared. But your book doesn't even go there. They just dump it right into retained earnings, right? So, so that's why I just said use market value for the debit to retained earnings. So when we go to do this journal entry, I'm sorry, this one right here, or something similar to it, we are going to be using market value to figure out this debit. Just, we'll do an example, but just kind of letting you know ahead of time. Here's the thing though. If you end up using market value, there's a 99.999999% chance that your market is going to be higher than that very extremely low par value of the stock. Remember last week I talked about companies established par value very small on purpose because it's illegal to sell stock below par. So the market is 99.99999% chance going to be higher than the par, right? So yeah, so they plan for that, and that's why they make it.
So far as normally negative?
No, not usually negative, but it's usually $1 or less, and by that point, you may not be there. It probably goes into a new set of rules when a company stock is like free falling, okay? But under normal circumstances, it's illegal to just sell that stock below the par, okay? So here is the date, the first date, the date of declaration when you're using a small stock dividend. So we're going to be in this environment here. Let's see if I can kind of block this out a little bit. So the journal entry on the date of declaration, so this is going to be a yellow entry to match the wording up top. So we are going to debit retained earnings. And just for shits and giggles here, I'll just say or stock dividends declared. This way I make everybody happy by putting the two possibilities there. So one of these debits would be appropriate, either stock dividends declared or retained earnings. You would then credit, we're talking common stock here, common stock dividends distributable. Think of it like payable. Remember earlier I said we got to get rid of the bull, distributable, payable. It's not actually a liability account, but it kind of acts like one. Okay. Common stock dividends distributable is just a temporary version of common stock. So that means this has to be recorded at par because this will eventually become common stock. So think about this for a second. Let me go back up here and do this. So if the debit is at market value and the credit is at par value, the chances of these two equaling slim to none. So let's say the par value is $1 and the market value is 10. 10 versus 1, I can't get these two to balance. So whenever I'm above par, we use our sidekick that we got introduced to last week, which was paid in capital, pick in excess of par. So when you go to do a stock dividend and it happens to be a small stock dividend, you will end up with 3 moves in this journal entry, and your debit will equal the total of your 2 credits. That's what the date of declaration looks like when you have a small stock dividend. There is no journal entry on the date of record. On the date of distribution, you're going to use my little terminology, let's get rid of the bull. And right now the bull is a credit, and the only way to get rid of something is to do the opposite of what's there, just like a closing. So you're going to debit your common stock dividends distributable. And again, remember this is at par. And on the date of distribution, you're actually giving the stockholder the stock you promised them back in the yellow entry. So the yellow entry could have happened a month ago. All right, stockholders, we're going to give you actual stock on this date. So here we are. We no longer owe you. So we're going to get rid of the owing part by debiting it, by getting rid of the bull. And now we're actually going to give them the common stock. And remember what I said last week. Every time you credit common stock, it's always credited at the par value. So because we knew this common stock was going to be at par and this would become common stock, that's why this had to be recorded at par initially. This is just the temporary version of that, of the common stock. And we're going to do an example with numbers so that you can see. But I just wanted to lay out the wording and things of that nature. Okay. So this is an example of a small stock dividend. Let's now look at a large stock dividend. Believe it or not, a large stock dividend is less work. One less line in these journal entries than we currently have. So in a large stock dividend, we use par value for the debit to retained earnings. So already, huge difference in mechanics. So in a large stock dividend, you use par value, you do not use market value. So look at the first journal entry on the data declaration. There's no PIK. There's no PIK because your debit is at par and your credit is at par. So there's no need for that PIK account. That PIK is just in case you're over par and you need to help make up that difference. And then on the date of distribution, it's going to look like the other data distribution. Get rid of the bull and credit common stock. So these are the journal entries associated with the stock dividends. So let's go into the textbook here. Let's see if I can find an exercise or a problem. I'm going to just turn on one of these lights here just to make it a little easier. That's because I'm boring. That's what. All right, so I'm going to go to the end of the chapter and probably snag something out of the QS questions if I can find something that seems good. Okay, I am looking at, my book is page 477, and I'm looking at QS 13-6. If you don't have the same page or whatever, I'm going to type it all out, so don't worry about it. But I'm looking at QS, it's right before the exercises. So if you get to the end of the chapter 13, find the exercises and problems, it's right before the exercises. So, what page is that?
570.
Page 570 one book, page 477 the other book. All right, so looking at this question, I'm just going to type it out here and then we'll go from there. So it doesn't matter what book you have, we'll just follow these instructions. It says prepare journal entries, bless you. So we'll just call it example. Prepare journal entries to record the following transactions. I don't care about the company name. And then it says July 15th. Make sure I'm not doing the wrong problem. July 15th. And on July 15th, it says declared a cash dividend payable to common stockholders of $165,000. And then the next one, we got August 15th. And it says date of record is August 15th to the cash dividend declared on July 15th. So date of record August 15th for the cash dividend declared on July 15th. And then August 31st, paid the dividends declared on July 15th. Okay, so this is a cash dividend situation. So basically it's going to look like this stuff over here. Okay, so let's go ahead and do that. So on July 15th, you would debit either cash dividends declared or retained earnings. I don't care which one you use for me, but when you're on the blended stuff, let's say you take a quiz and like, I swear that's right. If you do an uppercase versus a lowercase, one of those quizzes could say you're wrong, and that's why it always bounces back to me for me to look at. So don't panic when you first get your quiz grade, because there's things that it might be like a short answer question that it can't decipher if you're right or wrong. So it could be something as, hey, I used cash dividends declared, I thought that was right, and the book might be looking for retained earnings, or vice versa. Or you capitalized the R and it didn't want you to capitalize. It's stuff like that, you know? So stuff we can't necessarily control. So anyways, you would debit cash dividends declared or retained earnings, and then you would credit dividends payable. And I'm not sure why I used the X, since we have the numbers now, so I'll fix that in a second. So that would be the answer to July 15th. Debit either cash dividends declared or retained earnings, and credit dividends payable. No entry on August 15th. You don't even write it. You don't even go there. It's a non-accounting issue. It's just FYI. Okay? So you go right to August 31st, and now get rid of the bold. Debit dividends payable for the 165, because it's like closing it out, and credit cash. And those are the answers to that question. So on the date of declaration, I never liked the shortcut as a student. I didn't like putting it into retained earnings, because cash dividends declared had the same lingo as the instruction. Declared, cash dividends declared. You know, because when we took tests, you had to memorize for these exams. So you're always looking for any little trick to help you get through that test. And that's what I use. So declared, that's the declared account. And then I was off and running with what I was supposed to do, you know. So, but the retained earnings is the easier way, because then you don't have to do closing entry number 4. So it saves you a step down the road. Okay. So now let's take a look at much to see. Okay, so now let's take a look at QS 13.7, the very next question. So let's write an example. And again, whether you've got the book or you don't have the book, I'm just going to type the question anyways. So Epic Inc. has 10,000 shares of $2 par. Common stock outstanding. Epic declares a 5% stock dividend. So immediately, large or small? Is this a large stock dividend or a small? It's small, right? The key is it's got to be 25% or less. So remember I said when you see questions, they're going to make it obvious. It's either going to be 5%, 10%, or 30, 40, or 50. You'll be able to tell small versus large. So Epic declares a 5% stock dividend on July 1st when the stock market value, this is the market value, is $8 a share. The stock dividend is distributed on July 20th, and then it wants us to prepare the journal entries. Okay. Okay, so a couple of things that we need to know here. First off, because this is a small stock dividend, we know that the debit to retained earnings will be for market value. That's the rule right here, right here. So whenever you have a small stock dividend, use market value to record the debit to retained earnings. So just following the rules. Right? So from a journal entry point of view, I'm going to debit. So this is on declares on July 1st. So on July 1st, I'm going to debit retained earnings. Can I just write RE for retained earnings? Okay. The math, I could also say or stock divs distributable. So one of those two is acceptable. So now I've got to figure out the math involved. So there were 10,000 shares. So there's 10,000. So imagine you are the sole stockholder, to make this simple. You have all 10,000 shares. Okay. So we're going to do some math here. If I take 10,000 shares and I multiply that by 5%, that's 500. So for you doing nothing other than being an owner of these shares, the company is giving you 500 free shares. That's what's happening. Okay? So you're going to take those 500 shares and you're going to multiply that by the market value. Okay? Let's put MV here. So 500 multiplied by 8, that's going to give me $4,000. No, not at all. So 500 times 8, 4,000. Now keep in mind, we also have to record what is the base value of that stock, right? And that's where the common stock dividends distributable at par comes in. So I'm going to credit the common stock dividends distributable. Actually, I'm going to go back and fix this language here. Dividends declared. That would be better. Okay, so in that first entry, debit retained earnings or debit stock dividends declared. So now I want to credit the common stock dividends distributable. And this is going to be those same 500 shares, but at par value. And the par in this problem was $2. So 500 times 2, that would be $1,000. So my debit to retained earnings is $4,000. My credit is for $1,000. Obviously, my debits don't equal my credit, so that's where I use the PIK. The PIK helps me make me balance, basically. So PIK in excess of par. So in essence, I could do the math in my head. It's $3,000, or I could do it by shares. I could say 500 shares multiplied by whatever the difference between the $8 market and the $2 par, which is $6. 500 times 6, that also gives me $3,000. So that's the date of declaration. No entry on the date of record. What's that?
When I went up grab a charge from the laptop of it, it's like nothing.
Really? What is going on with this weather this summer?
It smells weird out there, but
Huh. Could be. I had a former student that used to work at Jeremiah's, and he told me some pretty horror stories that were going on in the kitchen there. So could very well be. But yeah, why couldn't we have this shitty weather during COVID? You know what I mean?
Yeah.
We're all coming back, and we got bad weather. Oh man. So anyway, on the date of distribution, which is July 20th, according to the instruction, let's now get rid of the bull. So we're going to debit the common stock dividends distributable. I'll spell it out this time. And the bull amount was $1,000. And now we're going to credit common stock. Keep these the same. And those are the answers to that question. So now let's do QS 13-9. We'll call it another example. And this one says Belkin Inc. has 100,000 shares, $3 par value, common stock outstanding. Notice the lingo. They declare a 40% stock dividend. So immediately you're thinking this is an example of a large one, right? 40% stock dividend. on March 2nd when the stock market value is $72 a share. What do we do with that 72?
So we multiply,
The trick question, actually. You do nothing with that 72 because this is a large stock dividend. Let me go back up to the notes. Because it's greater than 25%, so it's a 40%, it's large, so you ignore the market and you use par value the whole way. Okay? So when we had a small stock dividend, we used the market value to help us figure out the debit. Now we're just going to use the par value only. So from a date perspective, let's see here. So it looks like it's March 2nd. So we are going to debit retained earnings or the stock dividends declared. And we're going to do, so now we got to do the percentage here. So 100,000 times 40%, $40,000. Not $40,000, 40,000 shares. And we're going to multiply that by the par. So 4 times 3, what's that? 120 grand. And because we use par, we're going to take the same 40,000 shares and multiply it by the $3 par. So just look at the difference between this entry when we had a small one and this entry when we had the large one. So in the small one, we needed the PIK account to help make up the difference because the market was $8, the par value was $2. But when you have a large stock dividend, you ignore the market. So you're both recording the debit and the credit at par, so you don't need that third step. Okay? And then the final step looks the same under both approaches. You would never know if you were dealing with a small or a large looking at this, the last entry. Did they give us a date? Oh, they only wanted the declaration, so they're not even asking us for this, but we're going to do it anyways. Let's pretend it's April 2nd. So we're going to get rid of the bull. So common stock, dividends distributable. And credit the common stock. And those are the solutions for that exercise. So Aliana, this was exercise 9. I'm not sure what it was in the book, but it doesn't matter. I typed the whole question on the screen anyways. So in my opinion, large stock dividend versus small stock dividend is the most challenging topic of this chapter. That's just, my own opinion. If you found that to be pretty good, you're ahead of the curve because most people usually stumble when it comes to this. Like when I gave tests in the past, that they would get the two mixed up. They would use market when they're supposed to use par, that sort of thing. But if you've got all the ammunition in front of you, like you guys have to do all this Blackboard stuff, there's no memory work. It's just a matter of referencing the book, the notes, the videos, that sort of thing. So it shouldn't be too bad. Okay, so we got about 10 minutes before we start losing Johnny, and then a few minutes after that, we start losing a few other people here. But let's do one more thing, And what I want to do is do a quick little comparison between common stock and preferred stock. And let's see if I can find something that'll help us do that. Yes, so on the next page, so Jeremy, on page 478, QS 13-13.
I'm not sure where it would be in your.
You said 13, that's 13.
No, yours would be. Let's see, it's dividends on non-cumulative preferred stock. Something like that. They may have added that to this edition. Not seeing it.
Okay, so I'll type it out again, so that everybody can follow along here. So if you have the older book, this is not in there, but the new book has it. All right, so let's go. I'm going to scroll down. So this is kind of like a new topic in essence. So we're going to talk about cash dividend. Common stock dividends versus preferred stock dividends. And I don't know if you remember me saying this last week, but only about 25% of publicly traded companies even have preferred stock. Most of them is just common only. Common is what's traded on the stock market. Preferred is more of an internal that is then convertible to common. Okay?
What is the preferred stock now? Entire trading.
Preferred stock is kind of like, hey, we're going to bring in this new CEO that was really good at another company, and to entice him to come to our company, we'll give them, not only stock options, but we'll give them preferred stock. And with preferred stock, you get first crack at dividends. So whenever the company decides they want to give out dividends, if you're a preferred stockholder, you get to put your money, your hand in the cookie jar first. Whatever's left goes to common. Not saying preferred gets a lot, but they get first shot. All right. It's not like, hey, I'm a preferred stockholder. It's just that's the protocol the company follows. Here's the money we want to give out. This is our pool of money. The first group of people that get that money, preferred, and then whatever's left over goes to common. It could be this much left over, or it could be this much left over. But there's more common stockholders than preferred. Okay, so that's just the first thing I want to point out there. So the question that's in the book. Let me make sure this is the right one I want to use. Yeah, okay. So one other thing about preferred stockholders, there's actually, and our chapter doesn't talk about this, they kind of save it for like upper level accounting courses like intermediate accounting, which is a famous next course that accounting majors would take. We don't offer the course here, but I know. I have bad memories myself as a student from that class, but there are actually 4 types of preferred stock, 4 different classes. There's only 2 that they talk about here. Okay, one of the types is non-cumulative preferred stock. And the second type is cumulative. So those are the 2 that are brought up in our chapter. If you had a choice as a preferred stockholder, you would prefer to have the cumulative, more money in your pocket versus non-cumulative. Right? Make a long story short about the differences between the 2. If you have cumulative preferred stock, you're guaranteed the dividend money, even in the years that the company doesn't have it. They'll remember and give you the money when they finally do have the money, right? Whereas if you have non-cumulative, if the company has no money this year, it's like, oh, well, sorry, You're no better than anybody else. No special preference. Preferred stock, right? So you would prefer to have the cumulative over the non-cumulative. So they remember you when it comes time for dividends, even when they can't afford it, right? Just think of it that way, right? So let's look at the example that they have. And I'm looking at exercise or QS 1313. It says Green Planet. And this will be the last thing we do tonight. We'll just go over 1313 and 1314. So Green Planet Corp has 5,000 shares of non-cumulative, so the crappier type. $10 preferred stock with a $2 par and 17,000 shares of common stock. Enjoy. Well, but yeah, you're not having the hot date tonight, but you know. All right, just watch the rest of this. I thought that was you, Johnny, standing up out of the corner of my eye. Okay. And look at the par value on this one, Johnny. It's 1 penny. Okay, so it might be a little bit more realistic, you know, purposely making that small.
Okay. So I know stocks drop down from low.
Yeah. God, kids, type. So then it says during its first 2 years, the company, I should say declared and paid, right? Yeah, declared and paid the following cash dividends. And it says compute the dividends paid each year to the two classes preferred and common. So they told us that year one, total cash dividends $800. And then year two, total cash dividends $1,700. So our job in this problem is to figure out, of that 800, how much is preferred going to get, how much is common going to get. And then the next year, out of the 1,700, how much is common going to get, and how much was preferred going to get, right? So the steps involved are like this. We first want to figure out what is the preferred stockholders portfolio value. So for preferred stock, we have to do the following math. We're going to take the 5,000 shares. We're going to multiply it by the 10% and then by the $2 par. So we're going to multiply by 10% and we're also going to multiply by $2. So if you do that calculation on your calculator, so 5,000 times 0.10 times 2, I get 1,000. Okay, so make this a dollar value. So what this means in people language is this is how much the preferred stockholders are entitled to get. What's that?
People language.
Yeah, I know. Because, you know, this is a whole other lingo here. But so what this $1,000 means is that's what preferred is like guaranteed to get. Every year they're supposed to, let me put it this way, they're entitled to $1,000, right? So I have to do this math first. It's kind of like my preliminary work to know what I have to play with. So now let me set up a little chart. Let's go year 1 and year 2. And in year 1, I want to figure out who's going to get this 800. Year 2, who's going to get the 1700. So this is me now doing like a little chart to kind of figure it all out. So I'm going to do something like this. And then I'll put preferred first, and then I'll put common second. Okay, so in year 1, the company only has $1,800 to give. I'm sorry, only has $800 to give, okay? So of that 800, believe it or not, preferred is going to get all of it. And common gets nothing. But preferred was supposed to get 1,000. The company doesn't have 1,000 to give, right? And remember, this is, where is it here? Non-cumulative. So it's the crappier kind of preferred stock. So in other words, even though they were entitled to 1,000, the company only had 800. That's what they get. They get the 800. It moves out on the other 200. Okay. In year 2, now the company has 1,700 to dish out. Preferred's going to get the first 1,000, and common will get whatever's left over, which is 700. All right, let's make a year 3, even though it wasn't in the problem. And let's say in year 3, the company has $10,000 to give. Well, preferred gets 1,000. Common would get 9,000. Now keep in mind, every one of those preferred stockholders also has common. So they get 2 hands in the cookie jar. So they get first crack, they get the first taste, and then they get the split, you know, whatever's left of that candy bar, they get another taste of the candy bar. So they're getting 2 bites.
Double dipping.
Yeah, double dipping, that's exactly it. Okay. So now I'm going to change the question just barely. And I'm going to change it by saying now, instead of non-cumulative, now the stock is cumulative. So just by getting rid of that word non, I made a huge change in the question. Okay, so let me kind of do this again. And let's get rid of these results. Okay, so everything's the same. I would still go through this math right here to figure out what's preferred entitled to. They're entitled to $1,000. The company has 800 in the first year, and preferred still gets the 800, and common gets nothing. However, the other 200 that preferred was supposed to have goes into what we call arrearage, meaning that we promise to pay them this $200 as soon as we have the money available. So 200 is in arrears. Basically, it means the company owes them. Okay?
Why would a company do that though?
Yeah, just to make it, hey, it's not just a shitty old preferred stock. This is cumulative, so guaranteed money no matter what. Even if we don't have it this year, when we do get it, you have it. Okay? So here we are in year 2. Year two, the company has 1,700. The first thing we do is we give them 200 from the arrearage. We take care of the old money first. Okay, so from arrears. Right, exactly. So out of that 1,700, 200 is gone. There's now 1,500 left. So common gets, preferred gets their normal $1,000, and so that's a grand total of 1,200, as you said. So I'm gonna have to move my numbers down a little bit here. Hang on a second. Put common all the way down here. Trying to type as fast as I can, and I'm realizing I can't type fast anymore. So common's going to get 1,200 of that 1,700. Preferred gets just 500 this time, whereas last time they got 700. Okay, and then in scenario 3, preferred gets 1,000. Common gets 9,000. You don't see any difference in that particular year because there's no arrearage to handle. Okay?
Never arrearage in preferred. Or I'm sorry, in common.
Right.
Don't care what you do.
All right, so we'll end here. And then next week we'll talk about treasury stock. And I think that we'll kind of put a nice bow on this material. Okay?
Yeah.
Ciao, and good luck and have fun on your date.
Oh,
He's got a hot date tonight.
Good luck.
thank you.
So I will upload
My
these.
hot date's not ours, it's sacred.
Oh, that's so sad. That shouldn't work like that. You should still have date night and hot dates.
Yeah.
You should.
She should. Matter should and does she. It's two totally different things, right? But you just gotta.